These next two videos are going to cover inventory and accounting for inventory. So the first thing we really need to attend to is what is the definition of inventory from an accounting standpoint? And those are the assets that we held for sale in our business operations or goods that will be used in the production of goods to be sold. So in that case, we're thinking more of a manufacturer with the raw materials, the work in process, finished goods. The former assets held for sale is any merchandising or retail company you can think of that is primarily in the business of selling its goods. We can also put inventory into long-term contracting companies. It could be like construction in progress. In that case, what we're looking at probably is something like a commercial high rise, defense contractors, things where the production of inventory doesn't happen within a year. That's still considered a current asset to a company who is doing long-term contracting because the definition of current assets is a year or an operating cycle, whichever is longer. And the operating cycle for industries that have to build or put together inventory over the course of more than a year is their operating cycle is longer than a year. So that's the general idea of what inventory is according to GAAP. There are two ways to measure inventory. One is so much more predominantly used. I've dropped most of my coverage of the second. So perpetual is the one that you learned about in introduction to the introductory course in financial accounting. And it's the one that is used by businesses. There's just those two methods. But again, the perpetual is preferred, especially in today's world of computing power and data storage. So under the perpetual system, we are continuously updating the inventory account. So there's many entries to the account inventory, debits and credits, and we're also recording cost of goods sold. Every time a sale happens, our cost of goods sold goes up and our inventory goes down. Okay. Debit to cost of goods sold, credit to inventory. That's how we work under the perpetual system. Under the periodic system, which is older, this was during the days before we had massive data storage and computing power. We would just alter the inventory account directly, debit it or credit it at the end of an accounting period. And we would do so only after we had taken a physical count of inventory. And I'll show you basically, the very simple equation of how that works. But in that case, in the case of the periodic system, cost of goods sold was only recorded at the end of an accounting period. So even though we were making thousands of sales, hundreds of thousands of sales during the period, we did not record a reduction to inventory, nor did we record cost of goods sold until the very end as an adjusting entry. So let's talk a little bit more about the perpetual system first. Um, it's a more simplified system because it appeals to fewer accounts. So appealing to fewer accounts, basically, you'll see I'll allude to some of the other accounts used in the periodic system, but all we're dealing is with the inventory account. Anytime we purchase anything, anytime we produce a finished good as a manufacturer, we debit the inventory account. And when we sell things, we debit cost of goods sold and credit the inventory account. And as I mentioned, the cost of goods sold account is being updated continuously along with the inventory account. And so both should give us a running total of what we should still have in storage and able to be sold. At the end of the period, we do still take a physical inventory count. So, if you've ever worked at a grocery store or retailer, you've probably, as an employee, done an inventory for your employer. And it's not fun, but basically, yeah, we got to count up what we have. And the advantage of the perpetual system is that since we have a continuously updated cost of goods sold and inventory account, right? We're always updating those two things as we're making purchases, selling items, etc. Then what we count in the physical inventory versus what we think we should have based on our accounting, we can get a sense of how much was perhaps stolen or spoiled, right? Went bad, rotted. If you're talking about produce, items like that are called shrinkage in an accounting system. We can call it a loss on inventory. We can also call it shrinkage, but it gives us the ability to see, like, is there any theft going on? Are we having some issues with efficiency and turning over the inventory and it's causing it to spoil? Anything like that. With a periodic system, we have more accounts, not just inventory, but we actually incorporate other accounts. One account is the purchases account. We also incorporate a purchase returns account, a purchase discount account, and a freight account. So 4 new accounts under the perpetual system, and it's one reason why it's a little bit unwieldy. You have to track all of these things separately, keep separate accounts for them. Not a huge deal, but why not simplify it into one? Because what happens is all of these things under a periodic system eventually got closed into inventory. So these were all temporary contra and adjunct accounts closed into inventory at the end of the period. So the periodic system basically had a bunch of middlemen accounts that in the end of things we decided weren't really all that necessary for a well-functioning inventory management approach. It didn't give us the data that that was wholly superior. And so since we have the ability, the computing power, the data bandwidth to record hundreds of thousands, if not millions of sales and compile them together, why not go with the perpetual system? So what is the relationship between these things and the perpetual system? Basically, purchases is equivalent to increasing inventory. So it would be, instead of debiting purchases under the perpetual system, we'll debit inventory under the perpetual system. Purchase returns are recorded as a credit to inventory. They would reduce inventory since we're returning something we repurchased as a business. The purchase discount, any discounts we take on inventory reduce the value of the inventory, the value in terms of the cost we paid. And so that is recorded as a credit to inventory under the perpetual system. And then freight in, because it cost us some money to bring that inventory to our place of business to sell it, this would increase the amount of inventory. We would debit inventory under a perpetual system. So this is what happens under the perpetual system. Increase, decrease, decrease, increase. This is what would have been done under the periodic system. I do want you to know a little bit about the periodic system, like the names of these accounts. I'm not going to have you do any periodic system journal entries or periodic system cost of goods sold. It is a good idea to know these things, if only for the fact that it might arise on the CPA exam, or just your general knowledge about how accounting has evolved over time. But there's very few businesses that still use the periodic system. So this is largely things I covered in my little talk there. When you buy something under the periodic system, we debit purchases, not inventory. There's no record being kept of sales when units are sold. The inventory account is only updated at the end of the period, and cost of goods sold is only recorded at the end of the period. And we do a physical count on end in order to deduce what was sold. So notice here, right? Like I said, no update to the inventory account So anytime we sell something, we don't update the inventory account. We also no cost of goods sold recorded. So we're not doing this on sale. These two things are not happening like they do under the perpetual method, which means that the only way the periodic system can get at what we actually sold after hundreds of thousands of transactions during the period is to take a physical inventory account at the end of the period to deduce what had been sold. And this is that equation. This equation actually serves our intuition well when analyzing other issues with inventory. So, and it's very common sense if you break it apart. We have our beginning inventory. So what we started with, right? And then we're going to add in what I'll call net purchases for brevity. And I'll explain what that is in a moment. So if we have what we began with and then add in whatever we've accumulated over the period, that gives us something called goods available for sale. And this is a good number to have under any inventory method. Um, and we'll talk a little bit more about why as we get into cost of goods sold more specifically. But this is basically, well, if I add what I had plus what I accumulated, this is what I should have that could be sold. Now, the physical count at the end of the period um, is then used to give me my ending inventory, right? That makes sense. Well, I'm just going to go around, count up the value of things that I still have around the store and in storage. And the difference between these two things, right? What I had available, less what I ended up with. Well, then businesses said basically, hey, that's our cost of goods sold because the difference between those two values should be what was sold during the period. Of course, this is problematic. This is going to be a biased cost of goods sold. And it's biased because you can't assume that just the value of what you ended up with, subtracted from the value of everything you had available, is definitely sold, right? Theft, spoilage, waste, all of that can give rise to mistakenly recorded cost of goods sold under the periodic method. So remember, this is really a periodic method item. We can still take pieces of this common sense idea that what I began with plus what I accumulated is what's available. And basically, what's available is dunked into two separate bins, right? Ending inventory and cost of goods sold. There's a little bit of slippage between those two that these two added together don't necessarily equal cost of goods available for sale when there has been theft. But by and large, we can say goods available for sale are a component or are made up of our ending inventory and our cost of goods sold, right? With just a little bit of a dollar value of theft, spoilage, and waste. The net purchases is a combination of all of those four accounts that I described on the prior page. It's your all the purchases you made at their full price, less any purchase discounts that you received, and also less any purchase returns because you wouldn't hold those anymore in your inventory. And then you add freight because the idea is we want to record any costs to obtain the inventory and get it into a saleable condition. Well, freight is the biggest of those costs typically for a manufacturer, for a retailer. And then this gives me, as I mentioned, net purchases. And I have those two equations typed below. I think they for whatever reason they work for me better vertically oriented rather than horizontally oriented. Okay, so looking at the two systems, just a comparison of, again, just another way of representing what we've said to this point. If a purchase is made under the perpetual system, I debit inventory and either I paid in cash or I paid on credit. Under the periodic system, instead of inventory, we debit purchases, same credit accounts. When a sale is made, right, under the perpetual system, we record that revenue stream. Maybe it came in as cash, maybe it was a credit sale, so we record an account receivable. We do record the sale in terms of the sales revenue and the cash received or the receivable that's due to us under the periodic system. But note, we do not record cost of goods sold or inventory. We only record that under the perpetual system, where we update cost of goods sold and inventory on a continuous basis. Here, we do not do that because we are going to make this rather monstrous looking adjusting entry in order to record cost of goods sold under the periodic method. Whereas if we're going to make any adjusting entry under the perpetual method, it's for that discrepancy between what the T account inventory says we should have and what we physically actually observe in our inventory account. So the value of X here, if you like equations rather than words, I do describe it here, but is basically what the ending inventory account balance is. So you're looking at that T account and figuring out what we should have ended up with if we accounted for all the purchases and sales that were recorded. Oops, not equals, minus the dollar value of physical count of inventory. So we go through, determine the dollar value of our physical count, subtract that from the ending value, and that gives me the amount of shrinkage that needs to be recorded, right? That's the amount of, oh crap, someone's stealing from us, we have waste going on, whatever it might be. So some of the issues with inventory are, when is that inventory actually ours? And the deciding factor is the legal title. It doesn't matter where the location of the inventory is. If I have legal title to the inventory, its geographic location is irrelevant. I record a debit to inventory. So when we purchase something, we should, as the buyer, only record the purchase when the legal title passes to the buyer. And there are specific arrangements that should sound somewhat familiar to you from your introductory course. FOB shipping versus FOB destination. So FOB shipping point is when the title passes when the goods are shipped. FOB destination, this is when the title passes when the goods reach their destination. So if we have a buyer seller, so the buyer is over here, the seller is over here. The seller is shipping inventory to the buyer. Under FOB shipping, this is the title passage. So it happens at that little hash mark point in time. And this is all under FOB shipping, which means the goods in transit anywhere along that line, anywhere on its way to the buyer, it doesn't matter where it is, it's on a truck, it's on a plane, it's on a boat. If it's not at the seller's place of residence, it's been shipped, it's the buyer's responsibility. They assume the risks and the benefits during that transit. Even though it hasn't reached me yet, it could be any point along this line, it still hasn't come to me, not in my physical possession, doesn't matter. I still record it as a debit to inventory on my balance sheet. It will increase my inventory. Now, the same thing on the destination side. This is the title passage when it reaches the buyer. So along that line, anywhere along this line, the buyer cannot record it, right? It's not theirs yet. The seller is still responsible for all the risks and benefits of ownership up until it reaches the buyer. That's FOB destination. So when it's FOB destination, if goods are still in transit, then we don't record a purchase as the buyer. They're still coming to me. They're on the boat, plane, whatever. It's not my stuff yet. Right? Consigned goods. Consigned goods are when we have given something to another company to sell on our behalf. Perhaps it could be a niche item. It could just be something that we don't have the expertise to sell. If you take, if you're trying to sell your car, you don't want to go the Craigslist route. Maybe you go to a car dealer. They are the agent for your sale. You're the principal. You're the owner. That's a principal agent relationship. In this case, the consignee, the person that I gave the item to sell for me, they're an agent acting on my behalf. They do not bear risks and rewards of ownership. They're just doing me a five, right? They're doing me a favor. They're selling it, well, not really, because they're going to charge a commission, but they are just a vessel to connect me, the seller, with a buyer. Because there's no passage of title when I do this, then the goods on consignment remain the property of the person who consigned them. So whether if I ship some inventory to another company to sell for me and they're just going to take a commission off of it, that's still my inventory. Someone gives something to me and I have it on my property and I'm selling it for them, it's not my inventory, right? Because I'm the consignor now. Think of Priceline, Hotels.com, any of the online travel oriented vendors. These are all agents of different consigners, okay? Not their inventory, just goods they're selling on someone else's behalf. Okay. And special sale agreements. So these ones are a little bit different. This is when, even though we have a transfer of title, there's not a transfer of the risks of ownership. So, for example, what's a risk of ownership? A risk of ownership is my asset falls apart, right? It doesn't function. It's not what I wanted. So it gets ruined, right? Those are all potential risks of ownership. So a very common example of this is sales with rates of return. Okay. So if I sell something to a customer and they have the right to return it, have I really transferred the risks of ownership to the customer? I haven't, because if something goes wrong with it, whatever it might be, they can return it. In this case, when we've already looked at it from the seller side, right? And accounts receivable, or we looked at, sorry, not just, we're still looking at it from the seller side, but we're looking at, accounts receivable and how to record debit to sales returns, a credit to the allowance for sales returns, or debit to sales returns, a credit to accounts receivable. When we are selling inventory on credit, then we are going to need to also adjust cost of goods sold and inventory on those items. In this case, we got Mira, and she's operating through credit sales, allows a 90-day return on all merchandise. The company made credit sales of 375 during the month of January, estimates that 3% of the sales will result in customer returns. Mira determines its sales price points by performing a 40% markup on their inventory. So I want to add just one more thing. Basically, let's say that $7,000 of sales were returned during January. So these are my actual returns, right? How would we record just the sales returns aspect of this? So we have $7,000 actually being returned. Um, we know that that's going to play into my estimate of returns. So when those are returned, then we would record a reversal because when we sold them, right? Actually, I probably need to do the whole thing here. So when we sold them, we had a debit to accounts receivable for 375, a credit to our sales revenue for 375. So this is at the point of sale. We would have to then also establish the cost of goods sold here. Now it says that they determine their sell price points by performing a 40% markup on the cost of inventory. So what that implies is 375,000 is 140% of, oops, the cost of things that I sold. So that doesn't come out to be a round number. I'll round it to the nearest dollar. So if I solve for cost of goods sold, just divide 375,000 by 1.4. Cost of goods sold is 267,857. So that's for what we sold. But we know that some of it's coming back, right? We record both of these right away because we're doing the perpetual system. We are matching costs with the revenues they help produce. The actual returns. Now let's just assume that there is zero ASR, that we began the period with a $0 allowance for sales returns. So if you recall from the last topic, if there was a balance there, we'd have to reduce that first. But without a balance, then we go straight to debiting sales returns. And crediting our accounts receivable account. Because they don't owe us any more money. So we cancel $7,000 of accounts. And of course, the sales returns pushes my net income down because I recorded revenue for all of those things I sold, but now 7,000 are coming back. So I have to reduce that. I also have to reduce accounts receivable, and that's an asset, of course, because those people don't owe me money. Now, with this, right, we're going to have to change a little bit here because we got some inventory back. And we also recorded cost of goods sold on things that ultimately we did not sell. So with this, then we're going to record just a reversal, a debit to inventory, because that inventory is coming back to us with the return, and a credit to cost of goods sold because I overestimated or I over recorded my cost of goods sold now that there's some returns coming back. Again, this is the sales price. So I have to translate that into what that would be in terms of cost. I use the same idea I did down here. 7,000 equal is 140% of what value? Cost of goods sold. So 7,000 divided by 1.4 gives me an even $5,000. So that's a first part of some things we have to consider about when this, how sales returns affect us. Now, the real part that you might not have anticipated, this makes sense, right? People are bringing stuff back, they don't have to pay for it, we get the inventory back. The part that might twist you a little bit is that even with the estimate, so now that was the actual returns. Now we're going to do the sale return estimate. Remember, this is the adjusting entry. So we estimate that 3% of all of our sales during the month are going to end up as returns. So that's 375,000 times 3%. And that gives me $11,250. Did I have $11,250 of returns? No, I didn't. I only had 7,000. And so I'm anticipating that another 4,250 are going to come back as returns. So that's when I have to make this additional adjusting entry. And credit, I'm not going to be able to write it all out here, the allowance for sales returns account. And of course, this still reduces net income, the debit to sales returns, the credit to ASR. ASR, remember, is a contract asset, and so it reduces assets. Now, again, even though this is just an estimate, even though it hasn't happened, we have to perform a reversal, as we did here, of this primary item, because even though they haven't come back yet, we are still estimating a net income effect based on the returns we still anticipate coming through. And so we're going to have to take that 4,250, do the exact same reversal in terms of accounts with a different amount, because we only have 4,250 still that we're expecting to come back. And that equals, write out the math again one more time. When I solve for cost of goods sold, I will round to the nearest dollar, 30, 36, 30, 36. Now, one thing that changes here is usually this goes into an estimate, an inventory estimate account. The cost of goods sold does get reversed just full force because we have reduced full force our net income. And when we credit cost of goods sold, we're crediting an expense account, which reduces it. So that's actually driving my inventory, my net income up. The inventory asset, again, is somewhat offset by this ASR, but some companies will keep it in a separate account, like they'll have their inventory account and then they'll have an inventory estimated inventory. And then when the returns actually come in, it becomes just it just becomes a credit to the inventory estimate and a debit to the inventory in the next period. Just a reclassification, not a new transaction at all. So that is some of the impacts of how we account for inventory and cost of goods sold with sales returns. Now, remember that if we cannot reliably estimate sales returns, then we cannot record revenue until the return window expires. And because that's true, we do not need to adjust cost of goods sold for accounts on sale until the return window expires. All right. Bill and hold transactions. This is when someone pays for the inventory, but the inventory is not shipped. This can happen for a few reasons, like companies do not want to, they have overcrowded warehouse, they're not going to use that inventory right away. And so if there's going to be a bill and hold transaction, there has to be an adequate rationale for the bill and hold. The goods have to be ready to be shipped and must be separately stored in the seller's inventory. Can't be sharing a warehouse with things that are going to be sold. Um, and the risks of ownership, if something was to happen to that inventory while it's still with the seller, it is therefore not the seller's responsibility. The risks of ownership has to be passed along to the consumer. Parking transactions are an interesting one. Parking transactions are with basically we're borrowing with inventory as collateral. So that means that I'm um, what I do is I just sell inventory to someone who has no intention of keeping it, but they're going to sell it back to me at a slightly higher price. So that slightly higher price is the interest on this borrowing transaction. Um, when this happens, it's not a sale. It's just considered actually a reduction of inventory. So it would be considered a reduction of inventory and you would receive the cash, but you would have underlying a liability that's going to require you to purchase that inventory back. And that's just not going to ever be any sort of revenue recorded in this transaction for a parking transaction. Costs that are included in the value of inventory. So what do we want to put in that inventory account? All costs traceable to the production of the product, direct materials, labor, etc. Those are the manufacturing costs. If we're talking about product costs, bringing the item to my place of business, any insurance or freight that was required on the way in, bringing it to my place of business. There could be some other costs embedded, like I have to get the inventory into a saleable condition. So if you needed to apply some costly process or some modification to the inventory in order to ultimately sell it as the retailer, then you would include those costs in the inventory almost as if you're a mini manufacturer. Um, Things that are not included in the value of inventory, any sort of selling expense. So when we have any sort of like commissions for sales, right, to employees for their sales volume, advertising, things of that nature, even employee wages, because we have to have someone selling the item. Those are not included in the cost of inventory. General administrative expenses like the rent so that you have a shelf to put the inventory on, right? A roof over your head so you can make sales. Those things are not included. Utilities in order to keep the lights on to sell things, those are not included. The last one seems a little different. Interest expense or purchase discounts forfeited. We'll talk about these below. So this is invoked in cash discounts on purchases. We ran into some similar terms with cash discounts on sales. But in this case, right, these are cash discounts when we purchase. And it is a very similar system in terms of how we record this gross and net method and all that. So we'll get another dose of that in a moment. But let's just look first at, all right, how do I make some journal entries with this information? Real basic entries under the perpetual system. So on 1/1/16, Kyle's entering a credit purchase agreement with its suppliers. They're going to buy 12,000 units, FOB shipping. Each unit cost them $10, $1.50 per unit shipping fee, and a 10-day return window once the merchandise arrives. The inventory arrived on 1/5/16. the inventory found, the buyer, the company found 140 units to be defective, returned them, and incurred labor and material costs of 50 cents per unit to get them into a final saleable condition. So for the purchase, remember, we're just going to go straight into the inventory account since we're using the perpetual method. And we bought them on credit. So now we're doing an account payable. It's a current liability. And many times I see students get this, they still want to be into that accounts receivable world, but a very different thing. If I have an account payable, that means I have to pay in the future. So that's a liability account. So that $10 is going to be times 12,000. That's going to be $120,000 of the value of inventory that's coming in and the account payable. So this is just the inventory purchase. Now, we also have some freight. And in my problems, to keep the payable separate from, to keep the freight out of the payable, because the payable can be subject to discount accounting. So we're going to just keep them separate. This is inventory purchased on credit. Freight's going to be in cash. So we had $1.50 per unit. That would be $18,000 of freight. And because we're doing the periodic system, that freight is just going to be debited to inventory instead of freight in. So it goes straight into the inventory account. And as I said, just making freight always cash, which it typically is, reduces the confusion about what payable is part of the inventory cost versus what part of the payable is freight. So it arrived at our docks on 1/1/15. Oh, sorry, just indicate this is freight so you can kind of keep that in mind. And why it's cash. Now we have 140 that were determined to be defective, right? So that 140 units that were returned and are defective. Now, how do we record that? It's going to be with a credit to inventory because we're getting rid of it. We're returning it. It came to my place of business. I recorded it within this $120,000 when I purchased it. But now we're going to turn around and give it back. This is not what we wanted. It's not high quality. We have 140 units, and that's $10 a unit. So that's going to be $1,400 of this inventory that's going back. And how did we pay for this inventory? Well, we haven't paid yet, right? We bought this on credit. So we're not getting money back for that. We paid for the freight, but we did not pay for the actual inventory. So we're going to debit my account payable, and I owe them $1,400 less than I had when I purchased it. That reduces my liability here. This reduces my asset. This is the return. If freight is reimbursed, which is something that I always assume in these problems, then we have another part, another one like this, because we recorded the freight as a debit to inventory and a credit to cash. Well, if I'm being reimbursed freight, that freight comes out of the inventory account with a credit, 50 cents per, so that's $70. And because I paid for that freight in cash, I do get $70 back. This is the refund on freight. And that's the return of inventory. And of course, a debit to cash increases assets, a credit to inventory reduces my assets. The final piece is that 50% per unit cost to get them into a final saleable condition. So we're only having to get the ones that I kept into a final sellable condition, right? So you got to keep your eye on that. We had 12,000 units and we returned 140. So that means that I kept of those 12,000, I kept 11,860 units kept. So that's the amount that have to be gotten into. That's horrible. That have to be put into a final sellable condition, which is 50 cents per unit. That's an additional cost that would go into my inventory account. Let's assume that we had to pay cash for that. Oop, wrong one. We paid cash and we put this into the inventory account with a debit. And that would be my final uh, entry that I would need to make in this particular problem. So those are the entries I would make under a perpetual system. Again, nicely simplified because everything's going into the inventory account. And we'll look at the actual payment here in the next video.